Hello and good afternoon to those of you streaming in now. We'll get started here shortly. Thank you for being here today. Hello and good afternoon again to those of you just now streaming. All right, well, we can go ahead and get started. My name is Domenica. I'm the CLE and Sections Manager here at the Cleveland Metropolitan Bar Association. Thank you for being here today. If you are tuning in for CLE credit, you have to do two things: complete the poll that will appear on your screen and complete the survey that will be sent to you via email following our conclusion today. If you have any questions, you can enter those into the Q&A function at the bottom of your screen. You can also use the chat to communicate with us as well. We'll raise the questions at the end of the program. The last 10 minutes, we can address those. But as they pop into your head, certainly enter those into the Q&A for sure. And with that, we can go ahead and get started. We have two exceptional speakers today: Wes Christian, who's the managing partner with Christian Levine Law Firm down in Houston, Texas, and Jason Harris, who is a financial advisor with Equitable Advisors, streaming in from Toledo, I believe. Yes, Jason?
Yeah, that's correct.
So thank you both for your time and energy you put on this program. Let's get into it.
Well, super. I'll be happy to start. Wes Christian here in Houston, Texas. Today, we're going to talk about a topic that's near and dear to my heart: naked short selling. I had co-authored a law review article for the Houston Law Review about 15 years ago called "How Exposed Are Investors?" But first, before I start, I want to thank a couple people. I want to thank Jason, who's my co-speaker today, who I've enjoyed working with to prepare for this. Of course, Carrie Burns and Domenica, who you just talked to, as well as Nicole Newman and Melanie Cruthertz, who actually updated this paper. I sent Domenica the paper that we did, the updated law review article, in effect, for this talk. And so that's available to you. If you will email her, she can forward that to you. I'd also like to thank the Warshaw Bernstein firm, my partner Alan Pollack, who's been doing these cases with me for 15 years. Cohen Milstein firm, who's recently joined doing one case. Also John Floyd of the Bondurant, Mixon and Elmore firm, who's been with me for many years on these cases. Bob Blakey, who wrote the federal racketeering statute and has been with us on the RICO side of this for years in state cause of action, as well as Carl Kerner with White and Williams firm, and Share Intel, David Winger, and Binds.net, Tom Rock. So all the thank yous are now out of the way. So let's get into the topic. What is short selling? Short selling, as many of you may know, is legal. Short selling is essentially making a bet, no different than Las Vegas, that a certain stock is going to go down. Let's say you buy it at you sell it at $100. You think the company's got issues. You have to deliver it 2 days later. In order to execute that short sale, you must have a reasonable basis upon which you can borrow a share. In fact, your broker is going to tell you you have to borrow a share. Ultimately, if 2 trading days later, the stock goes down to $90, you go into the market, buy a share at $90, deliver it to the person you sold it to, you make $10 a share, the difference between the $100 you sold it at and the $90 that you bought it at. That's called a short sale. At that point in time, you return the borrowed share to the person or entity from whom you borrowed it from. That's short selling. Naked short selling, unlike some of my friends say jokingly, is not sitting at your desktop in your house naked and trading stock. It is actually doing something that is illegal. It is taking stock and selling it short, not borrowing the share, and deliver nothing. As I told Charles Payne on Fox Business recently, it essentially is stealing. It is no different than Xeroxing your car title 100 times and you only have one car. You sold it to 100 people, but there's only one car. So how does that impact people? We're going to talk about that. So naked short selling is illegal. It was attempted to be regulated effective January 1st of 2005, but still needs more regulation. We're going to get into that also. So how is this allowed to happen? One of the questions I get frequently in various CLEs, I've spoken on many topics, but this is one of my favorite, is how can this happen? Well, it can happen because, number one, many of the people and institutions doing it are actually the people that control a good part of our financial system. The Depository Trust Corporation is owned by one of the exchanges, as well as many of the prime brokers. That's a self-regulatory organization, and ultimately it governs itself. It is, in fact, from where we sit, in my belief, that much of this comes from the prop trading desk of the prime brokers and the stock lending desk of the prime brokers. Further, Wall Street has gone paperless. Like most of us in our legal profession and in our life, we've gone paperless. Well, one of the downfalls of that paperless system is physical stock certificates no longer transfer. It's easy to figure out that you have the stock if you have the physical stock. Well, today that's been replaced by an electronic entry. So in reality, based on the 21 cases we've litigated so far in the last 20 years or so, soon to be several more that we're working on, ultimately, many people who have account statements that say they have the stock simply don't. The root cause of that is lending stock that doesn't exist that creates a naked short sale, or selling stock that you don't deliver, which creates a naked short sale, or both. And it's the lack of those physical certificates. It's the lack of the governance being overseen. I would call that the fox in the hen house. And it's the lack of the proper oversight, reconciliation, and accounting for the clearance and settlement system, in my opinion. The reality is, according to Dr. Rob Shapiro, who's one of our experts, and I needed to thank him also, I forgot him. He was a co-author of my law review article and is still an expert 15 years later. He's our chief damage expert, Dr. Rob Shapiro, who was the former Undersecretary of Commerce during the Clinton administration, says 500 million to 1 billion shares per day are sold but not delivered. That's a staggering number. That's across all exchanges. If you look and extrapolate that out to 30 or 60 days later, the number goes measurably down, but it's still hundreds of millions of shares that are not being timely delivered, counting all exchanges in our stock trading system. As you would imagine, that really gives a black eye really to the integrity of our capital markets. And we're going to get into the other consequences. So what are the effects of naked short selling really on all of us as consumers and citizens and businessmen and women? The effects are, one, much of the stock in these mid-cap companies, I want to clarify this point, naked short selling really can't be done in large part in the large cap companies, the Microsofts, the IBMs, et cetera. It's more in clients of ours like Overstock.com. Another client of ours was the Taser Gun Company. Another client of ours was Pet Quarters, Inc. Some recent clients of ours are, MICT, a multi-billion-dollar rev company with, strong balance sheet, or Eagle Tech Communications and others, which are all companies that ultimately had their stock, we believe, naked short sold. Ultimately, many shareholders don't own shares in that company that are real. You can call them counterfeit, they're called phantom, they're called many things, but at the end of the day, if everybody went to redeem their shares at the same time at the transfer agent, say, give me my shares and account for them, there would be more shares that are in the marketplace than the corporation is actually issued. And don't forget, legally, it is the corporation that has the sole authority to issue those shares. And their books are the ultimate, accurate counting of the issued and outstanding shares that are reported in Qs and Ks. Ultimately, though, most accountants can't even account for the number of phantom shares, so how do you count them? Well, fortunately for us, with the ability of Share Intel and Tom Rock, Viance.net, and our proprietary systems, we figured out a way to do that for the most part, sufficient to get past a motion to dismiss and ultimately get into discovery. Other impacts are, this destroys corporate governance. Corporate governance is important. It's important because everybody should have a right to vote their shares. That's simply not happening because there is overhang. And you can document this by going to the documentary that actually brought me here to the Cleveland Bar, and thank you very much for that, the Cleveland Bar, to talk about this. The movie is Gaming Wall Street. It's HBO Max. It's a documentary special, Gaming Wall Street. Dr. Suzanne Trimbath, who used to work at the DTC, said this started decades ago, where there was more stock at the DTC than there was, actual shares, called overvoting. Some people call it overhang, and it's gotten progressively worse. Why? Because I believe the Depository Trust Corporation bought the National Securities Clearing Corporation in the late 90s, and that company does nothing but lend stock. So stock lending began a huge deal. What's the other impact? The other impact is, not only does this impact your retirement accounts who are investing in small cap and mid cap companies, it affects your ability to have your stock appreciate. Why? Because anybody who signs a margin agreement at your broker means that you bought stock for cash, you bought 10,000 shares. Oh, but you think it's such a good idea, you want to buy 5,000 more shares, but you don't have the cash. You then go to that broker and say, hey, can I borrow against my shares? And typically they will say yes. They'll establish a margin account. When the fine print of that margin account agreement in most brokers, there are some exceptions, it says they can lend your stock. And if they lend your stock, almost without exception, it's going to go to short sellers. Why do we live in a country where you're going to buy stock to appreciate, but your broker can lend it to short sellers, which it seems is going to cause the stock to go down? But believe it or not, that's legal because that's the contract you sign. But that's another impact. Your stock simply is going to have not a natural ability to appreciate if your stock is being lent to short sellers. Ultimately, other impacts are the corporate governance is so destroyed. How do you account for this in a merger or an acquisition? Many smaller companies merge with larger companies. How do you have the ability to count the real shares? And that becomes incredibly difficult. Ultimately, this is big business for brokers. If you look at the prime brokers, Merrill Lynch, Credit Suisse, Deutsche Bank, UBS, Morgan, etc., you're going to see that proprietary trading, which is a part of this, and stock lending makes billions of dollars for Wall Street. It's big business. So they have incentive to do this. And if you look at the documentary and you look at the enforcement actions that I'm going to get into in a minute after Jason speaks, you'll see that FINRA and the SEC have fined most of these firms for loaning stock they don't have, and it appears in the documentary, the HBO documentary, under F3. There's a whistleblower in that movie that said, oh yeah, we just kept lending it. We didn't have the stock, but we just hit F3 and just kept lending it, and the money keeps coming in. And that's really just another way of stealing, I call it in Texas. So at the end of the day, there is no positive benefit to naked short selling. If this happened, I suggest to my fellow lawyers listening, where you were counterfeiting $20 bills, you'd be in jail by Friday and be buried 6 feet under 2 weeks later, okay? This involves trillions of dollars, multiple trillions of dollars, according to our experts. Some say as high as $100 trillion over the last 20 years. I have no idea if that number is accurate, but that number's been spoken. The bottom line is very few have gone to jail. For the first time, I'll give you a little glimpse of one of the enforcement actions. In recent history, 3 of the Morgan brokers or individuals, human beings, got tried in Chicago, not too far from you guys, and convicted of spoofing the metals market. Just spoofing the metals market. We're going to get into what spoofing is later in this speech, and paid over $900 million in a fine. And I grew up on a ranch in Texas, so my dad kept things pretty simple. You know, if somebody can pay a $900 million fine, they're stealing from somebody, okay? So how can you do that as a cost of doing your business? And that's the problem with this illegal practice. While the SEC and FINRA are doing things about it over the years, It's simply a token amount of money from my view, and more needs to be done. With that, I'm going to turn it over to my colleague who I've really enjoyed working with, Jason Harris. And he's going to talk to you about what this looks like diagrammatically and also give you the example of GameStop, which is a textbook example of what I've been talking about. Jason, your show.
Thank you, Wes. I appreciate that. Yeah, it's really enjoyed working with Wes, and I hope you welcome everyone from Cleveland. Wes was nice enough to bless us with some of that Texas weather, although we got a little bit of wind, but it is, nice 50, 60 degree day out there. So I'm going to share my screen real quick and we'll jump into it here. So hopefully everybody can see my screen okay. So I'm going to dive a little bit more into the actual mechanics and the details. Wes did a great job of covering, giving a great example of exactly how short selling works. I'm going to touch on a couple other highlights and walk through that GameStop example. But real quick before we get started here, this is for educational, informational purposes. Anything I'd say moving forward is just, it's meant to be for education information. It's not financial advice, legal advice, or tax advice. I'll leave that to you guys. You guys are the legal professionals. So as Wes had mentioned, what is short selling, right? Short selling it can be used in multiple facets. One of the most common ways is when you're short selling, you're betting that against the stock, that the stock will go down. Now, there are pros and cons to short selling. Obviously, one of the pro side, I guess, looking at short selling would be it actually is used also as a hedge against a long position. So a lot of times institutions, if, for example, using 2022 as a great year to, as everybody, if you've looked at your retirement accounts or you've been following the markets, you know exactly what kind of pullback we had in 2022. But if somebody owns a basket of stocks, they own a large portfolio that they don't want to sell, one of the ways they can hedge that position in order to reduce the amount of loss in that portfolio is by shorting against that portfolio or shorting against a specific position. A lot of times short selling can have a negative connotation, and that's really what Wes is talking about. He's really trying to expose some of the negative side of short selling, but there are other purposes for it as well. So as he mentioned, how it works, the investor is borrowing from your broker. Somebody is owning those shares. Another person using that same broker will ask the broker to borrow it. Not too long ago in my trading career, before I was in this role, it used to have to pick up a phone and call your broker. You would call an 800 number, you'd call a specific customer service line, and you would ask them, hey, I'm looking to short this stock. Do you have shares available? They would do it, they would type it up on their computer. They would tell you, yes, we have this many short shares available to short. Here's what the cost is going to be. Would you like to secure those? And you would actually secure those, and they would lend you the shares. Whether you use them or not, you would still be paying for them. And then usually the person who they're lending them from is going to receive some minor compensation, maybe 1.5%, as long as that other person is borrowing those shares before they have to give them back. Now, one of the negative sides to short selling as a investor or a trader is short selling has unlimited loss potential, right? If you're long a stock and a stock goes up to 50, the most a stock can go down is 0. So you know what your limit is, right? You know what your loss limit is. When it comes to short selling, in theory, a stock could go to infinite, right? It has infinite upside to go. So your losses can be unlimited, and it's why it's extremely risky when you're talking about it from a trader or an investor side perspective. Now, let's talk about kind of the other side of what can happen if you're a short seller or you are short a stock. And like Wes was mentioning, one of the most recent examples or widely known recent examples is GameStop and AMC. So what is a short squeeze? A short squeeze is essentially when a price moves above a certain level and you have a big influx of volume creating this upward momentum, essentially putting pressure, right? When you squeeze something, you're putting pressure on that. That's exactly what's happening to the stock. You're putting pressure on that stock and it rises at a very, exponential momentum speed compared to what you would normally see it on a normal trajectory of a stock. Now, how that works is you essentially have buying on top of buying. The natural long trader is buying as the stock is going up. Then the short seller, in order, as Wes had mentioned in the beginning, when you short a stock, you then have to buy back in order to get out of the position or close the position. So you have buying on top of buying, and it creates this upward momentum in this fast, high trajectory to the upside. So one of the things that everybody likes to look at is the fundamental side. If you're an investor, if you're a trader, if you're looking at something for your 401k, or you want to know more specifics about a stock, there's two sides of it. There's the fundamental side. There's the technical side. One of the websites I like to use, and you can see here, this is finviz.com. It's a free website. It offers a lot of great information. I'm using GameStop as an example, but there's, depending on what your strategy is, the fundamentals are extremely important. There are some people that are more short-term traders. They're just focused on the technicals. As you can see, through FinViz, you can see the market cap of a stock. You can look at their sales. A lot of times, you'll see the PE and the forward PE. You can see if the stock is optionable, if it's shortable. But one of the things I really want to focus on is when Wes had mentioned this, kind of the outstanding shares, the shares in the float, the short ratio, and then the short interest. So what does all that mean, right? What is all the technical terms? So shares outstanding means when a stock goes from a private company to a public company, the company needs to figure out how many shares they want to authorize to be traded on the open market. The shares in the float are actually the number of shares available, traded, or tradable for the general public. Now, as you can see between these numbers, between the shares outstanding and the shares float, you have a discrepancy, right? The amount of authorized shares versus the ones that are tradable to the public is a different number. And the reason is some of those are going to be held by the company in treasury. Some are going to be held by institutions or insiders, and some of them are going to be restricted stock that are not available and able to be traded on the open market. So that's how you get that difference. The float is actually what is tradable all day, every day in the general public. Now, the short interest is the number of shares sold and outstanding. So you can see here, the short interest is 58.41 million out of the 256 million available to be traded at that time. The percentage of that ratio is then just the difference, doing some basic division. The reason this is in red at 22.73% is because anything over 10% is considered high short interest. And we'll talk about why this is important here in a little bit. So going back to GameStop. So this is actually, we're coming up. We just had really the 2-year anniversary from this GameStop phenomenon, this short squeeze. And this was actually a screenshot I had taken at the time this was all going on. This is actually my trading platform. And what happens is when a price, and whether you're an institution, whether you're just a retail trader, whether you're and what's not talked about a lot is all the high frequency trading, the computer trading, the algorithms, they're a big part of this. But what happens is when a stock spends a long period of time building a base at a certain level or a certain price, once that stock breaks through that price, there will be multiple triggers that go off, whether it's on somebody's platform, whether it's on an institution's. There are certain key levels that are marked, and this creates more interest in the long side. And as you can see, if these candles or the stock itself is the vehicle, volume is the gas behind that vehicle, right? So as you can see, on a normal trading volume day, the volume is much lower. The stock has a lot shorter range from high to low. But what happens when you add gas or rocket fuel to that trading? This is what happens. The stock moves above its normal expectations or its normal trading range, and you create this upward momentum. Once we break certain price levels or certain levels, if you shorted a stock at 40, the stock is now at 50, you are now losing money. So you're going to have one of two options. You either have to hope the stock comes down and you hold on to your stock, or you have to cover your position. And after so much time goes by, there is actually, the broker will make that decision for you at some point. But you can see how adding volume to a normal trading range break can create this upward momentum. And when you have that high short interest, you have buying going on, you have the gasoline out of the fire, you have short covering on top of buying, it can create this upward momentum on the stock. And this was actually just the start of what happened with GameStop. Here is what happened next. So those volume days I showed you are actually back in here. The following preceding days, when the stock actually started to really break out, that's where you see these giant volume days where the stock had upward momentum, because now it was on everybody's radar. You had CNBC talking about it, Bloomberg talking about it. It's coming across the social media wires. Next thing you know, there's interest on top of interest. You have giant volume. You have algorithms getting in on this. Institutions are getting on this. The Wall Street sharks sense blood in the water. They're getting in on this. And it just creates this upward momentum. And I'm not even really going to get into the options side of it, but there's a whole gamma component to this that goes on as well. But during this time in January, from the January 1st to January 27th, back in 2021, just over 2 years ago, here are some of the stocks that had at least 25% short interest or more during that time that had that same kind of squeeze or effect. Some of these you heard about, right? Some of these you're aware of, some of these you know. But for example, GameStop was one of those. And this is where what Wes is going to continue talking about today, where that naked short selling comes in. How does a stock have 120% of its short interest or of its outstanding shares being short? How does that happen? How do you have more than 100% of something? And actually at one point, I think it was recorded GameStop was at 138, maybe almost 148% at its peak short interest. So some of these, some of these saw some really upward momentum. Bed Bath & Beyond, I'll talk about a couple other things real quick on that one, but AMC, GameStop, well, those were two of the most common due to Reddit and the exposure that they gained. But some of the other ones that saw some big squeezes were iRobot, SunPower, National Beverage, and all of these are no different than any other stock. The market, when it senses blood in the water, it will start finding these stocks with these short interests, these lower float stocks, big short interest, and it will create this short-term frenzy of short squeezes. Now, what other factors can tie into a short squeeze? It's going to be a news catalyst, algorithms. They will sense these breaks. They're triggered to buy certain breaks. Naked short selling, which is what Wes is describing today. And then you can also form a gamma squeeze. Part of, and let me back up quick here. Part of what we saw here on this GameStop along not only with the short selling, the naked short selling, but there was also a gamma component of this, which is created by the option side. And not to get too much into the weeds or the details, but basically what a gamma squeeze is when you have options, say, for example, the stock is trading at 150, then you have options buying at 300, right? The market makers then have to buy the underlying stock to cover their option position. So it creates this, already you have regular buying, short covering. Now you have market makers having to hedge their positions through gamma, through the options market. It creates this widespread frenzy of buying and hedging. So this is how this happens. Now, the other thing you may remember, for those that were in tune with what was going on at the time, this big gap, I know it's probably harder to see here, but there's a gap between the price action here down to here. This big gap is where Robinhood actually halted the ability to long GameStop. And once you kind of pull the air or the rug underneath that momentum, that's when the momentum really got killed. And you see then the fallout from the stopping of that trading. So that's really what I wanted to cover, just some of the mechanics. Again, we'll dive into some questions and things after that. At this time, I'll hand it back over to Wes, and he can continue on describing more of this naked short selling for you.
Yeah, super. Awesome presentation, Jason. Ties in exactly to what I think is important for them to know. A couple things I want to distinguish in certain situations. What you're going to hear from me is that a lot of these tickets, because you have to mark them long, short, or exempt, are intentionally, even though they're short, marked long. So actually the reported short interest in the companies that we come to see that are being manipulated is 2 to 3 times what the reported short interest is, because when you mark it long and commit more lies, I'm going to tell you, then ultimately at the end of the day, that leads to more dissemination of false information into the marketplace. The short interest is much greater, we find. Also, each day, the brokers publish a list of hard to borrow or easy to borrow stocks. The percentage that Jason was talking about, and I think he'll agree with me on this, is the easy to borrow stocks. On the hard to borrow stocks, I've seen the negative rebate be as high as 40%. Insanity. Again, who can pay 40%? People that are delivering nothing. That's my answer. You can't pay 40%, and survive, so to speak. Okay. So at the end of the day, that's important. So what have the regulators done about this, and who's addressing this? Well, first, a group of us, John O'Quinn was my first partner, although he passed away in 2009, sadly in a car accident, which is how I picked up Alan Pollack at Warshaw Bernstein as a great partner in place of John. But we, along with Patrick Byrne at Overstock, which was our first big client, and others, American Chamber of Commerce, lobbied the SEC and Congress to pass some type of short regulation that stopped this. And while Reg Show, that's Sierra Hotel Oscar, Reg Show, acronym for short, which went into effect January 1 of 2005, and while we had a lot of lobbying efforts we paid for in that, and many meetings with the SEC on that, et cetera, at least it passed something. So I want to just run through those rules. One, under Rule 200 of Reg Show, you must mark a ticket accurately. So what? The first day that failure to deliver list, or the threshold list, they call it, came out, January 1 of 2005, it had an enormous amount of companies on it. Well, today it's very small. I can't prove this, but my belief is it's because most of the tickets are marked long, okay? And if you look at the fines that have been issued by FINRA and the SEC, you'll see that there are tens of millions of dollars of fines from broker mismarking tickets. Again, it causes dissemination of false information. Two, under Rule 203B1-2 of Reg Show, you must have a reasonable basis to borrow the share. As you can imagine, many people have what I would call very loose interpretations of a reasonable basis to borrow. What we've learned in our case is, you want locates on the share? Sure, we'll give you a locate, we'll give you a locate, we'll give you more locate. And in many cases, they simply don't have the shares, but they're happy to take your money. Rule 204 has closeout requirements. That varies whether you're a market maker, and I'm going to get into the market maker exception in a minute, whether it's a short sale, a long sale, etc. Those rules are too complicated to get into. At the end of the day, today, the rules were amended in 2009 and the anti-fraud rule was put into effect. And so there have been some other amendments, but the one amendment that needs to happen today is the elimination of the bona fide market maker exemption. A market maker, as you know, is there to create activity in the stock. And in theory, a market maker at the end of the day should be zero. Their long should offset their shorts. But in reality, that is not what's happening today, because of what Jason alluded to 100% accurately. And that is, there are these algorithms that are pre-programmed that do a lot of this trading. The dark pools, many of these stocks, ladies and gentlemen, are traded outside the venue on which they're listed. You're listed on NASDAQ. Most of our clients don't trade on NASDAQ. They trade on other exchanges because those exchanges don't have the transparency. They don't have the oversight. So there's a whole nother problem with allowing all these multiple exchanges, including exchanges out of the country. That's a whole different topic we don't have time for today. At the end of the day, the SEC and the FINRA have been attempting to do things about this. There are literally, if you go to the documentary Gaming Wall Street with HBO, you're going to see they give you a picture of this, but you have to read them in a flash. I'm just going to read you the recent ones. You know, UBS was fined $12 million in 2011 for violations of Reg Show. And I'm not going to get into the details of the violations. It was one of the things I just articulated. Again, in 2022, they were fined $2.5 million for more Reg Show violations. Goldman Sachs was fined $15 million by the SEC in 2016 for short sale locate requests. Merrill Lynch was fined $9 million by the SEC in 2015. Merrill Lynch Professional Clearing Corporation was fined $3.5 million in 2014. Merrill Lynch was again fined in 2021 for $850,000 for violating Reg Show. In June of 2014, Merrill Lynch and Goldman Sachs and Barclays Capital, $1 million each for reporting short sales as long on their blue sheets. Blue sheets are something submitted to the SEC with a lot more detail. Credit Suisse was fined $1.75 million for violating Reg Show. Deutsche Bank was fined $1.4 million by FINRA, etc. The list is single-spaced, is multiple pages long. It is billions, ladies and gentlemen, not millions, billions of fines just for this. That doesn't count the other illegal activities you hear about for other violations, okay? And as I alluded to a minute ago, in September of 2020, JP Morgan Chase and Company paid $920 million as a criminal monetary penalty and disgorgement for spoofing these markets. And in August 5th, 2021, a federal jury convicted 2 ex-Bank of America traders for wire fraud related to a fraudulent scheme to manipulate commodities. And I also told you about the other individuals with Morgan. So how do we ultimately package this and put into a complaint? What we've done is look at federal law and complaints associated with that and look at various state laws. Most state laws have securities laws that are either misrepresentation and fraud or manipulation. Our case is really about stock manipulation. So most of our cases, if it's federal, are brought under 10b-5. 10b-5 basically says, and I'll read it real quickly, it shall be unlawful for any person directly or indirectly by the use of any means or instrumentalities of interstate commerce or of the mails or any facility of National Securities Exchange to use or employ in connection with the person, sale of security, any agreement or manipulative or deceptive device or contravene in contravention of such rules, etc. This statute allows us to sue for manipulation, and the basis of that manipulation is the dissemination of false information into the marketplace, and these devices that they use to portray something that's real when in fact it's not real. The sale of a naked short sale is not real shares. The lending of shares that don't exist is not a valid loan. The spoofing of a market, putting baiting orders up, and I'll get into explain that in a minute, are not real because they're taken down at the end of the day. No different than wash sales and match trades in the old days, which is still going on. In addition, we use 9A2 of the Security and Exchange Act. It makes it unlawful to engage in a series of manipulative transactions in any security creating actual or apparent active trading in such a security or raising or depressing the price of equity. So we use that statute because, in fact, the behavior I've articulated violates 9A2. Now, there are a couple problems with that because I got to tell you, Wall Street is represented by some of the best lawyers in town, for sure. And so I've enjoyed litigating against those individuals for 20 years with our team. Again, this isn't just my firm. This is multiple firms on this massive team we have. They got passed in 1995 a law called the Private Securities Litigation Reform Act. What that means is if you're going to bring a securities law claim, ultimately you better have definitive facts to plead in your complaint, because if not, the case is going to get dismissed. And oh, incidentally, as a private citizen, that's pretty difficult because the facts you have to have are going to be something that shows that all these causes of action you're pleading are actually actionable. And you don't get any discovery until that motion to dismiss is ruled on. Fortunately, the first 2 or 3 cases we filed, we weren't very successful because that was in 2000, 2001, 2002. We really didn't understand. After that, we hired the best of the best experts. I've thanked most of them on the call at the beginning of the talk. Basically learned everything about the stock lending, stock clearing, this clearing and settlement system, who all's involved, how are they cheating the system, et cetera, what the rules and regs are, et cetera. And we were able to put together a team that did that. That first started with Overstock and the great lawyers I hired in San Francisco to help do that case as lead counsel. And all that culminated in some of this is public and 8-figure settlements. And then smaller portions that I can't disclose in that case with other players that involve hedge funds and others. In addition, we brought cases in state court because many states, almost every state, has a state security statute. Many of those states, incidentally, have a manipulation statute also. It's important to note, and I apologize I did not have time to look and see if Ohio has a manipulation statute, but you would certainly need to look at that if you were going to bring this claim in Ohio. And many states also have a corresponding civil RICO statute under state law. We've had great success in Atlanta, Florida, and other states that have civil RICO statutes, which typically a predicate act, two or more predicate acts of fraud within a 5-year period gets you a predicate to sue for civil RICO, and then ultimately you have a shot at, it varies state by state, treble damages, attorney's fees, etc. So ultimately, civil RICO is available under state law. It is not available under federal law. One of the other things the very smart lawyers did representing Wall Street is get federal RICO excluded from securities fraud. So you cannot bring a federal RICO claim, can you believe that, in the context of a federal securities fraud claim. So, we started out with Internet Law Library. We then went to Nano Pierce. Sedona Corporation was another case of ours against Ladenburg Thalmann. That case settled. But more importantly, we were able to show criminal behavior in that with the Thomas Badian and Andreas Badian brothers, 2 of which got indicted, one of which is still a criminal in flight, to my knowledge, Thomas Badian. And that ultimately led to Refco. If you remember, Refco was this enormous firm that blew up within a year of its IPO. And I remember looking at their bankruptcy schedules, and they had like $900 million of undelivered securities on their balance sheet, marked to market, incidentally, at the time they filed bankruptcy. God knows what the number was when they actually sold the securities naked. So that worked. We were also involved in the Operation Bermuda Short. So that's another criminal endeavor that we worked with the Justice Department and SEC on, involving Mark Ballantyne, et cetera. And we worked also with other members of the SEC. We then did the Eagle Tech Communication case, which involved, incidentally, organized crime being involved in this. There's a deposition from a guy named John Sarubo that's on the internet. You can watch if you're bored some evening. He'll explain to you how they did it. He died in the chronology of that case, but nonetheless gave his deposition and somehow put it on the internet, ironically. But that was a civil RICO case. Then we did the Razor Technology case. Unfortunately, a portion of that got dismissed on claim preclusion. And then we have 2 cases pending in New York. If you're bored to death, Harrington in the Southern District of New York and the Northwest Bio case. Harrington is the Warsaw Bernstein firm and us that are doing that case. The Cohen-Milstein firm is lead in the Northwest Bio case. So at the end of the day, the most current manipulation that they're using is spoofing. If you look at the Harrington case and the Northwest Bio case, if you want to get intellectually challenged, you'll read 20 or 30 pages of spoofing evidence. What is spoofing? Spoofing is where market makers post orders, in this case, orders to sell, and stack them up like it's a massive amount of stock fixing to be sold. Those are called baiting orders if they're not real. They're intended to bait you into taking action. So if you look at that and you see, oh my God, look at all the people selling. We got problems, Charlie. We gotta fix this. Okay. Well, ultimately, we better sell too because the stock's going down, down, down. But then those orders are withdrawn. They're not consummated. No different than in our cases we've seen, and the SEC addresses this in some of their enforcement actions. You can go buy a put and put it with a call in the option markets and create a synthetic share. But if the 2 parties are conspirators in this, and they've got a 50,000 block of shares in this option contract, an option contract is basically a futures contract. I'm going to sign it today, and we're going to settle up in the future. One person thinks it's going down, one person thinks it's going up. You put it together, that makes a synthetic share according to Wall Street. I disagree with that, but that's their version. And at the end of the day, 2 days before the contract is to mature, they tear it up. It's another fake way that they trick everybody into thinking, oh, I've got real shares, but in fact, you really don't. So we've only got about 5 more minutes. I could talk for another 2 hours, but I'm going to save 10 minutes for questions. So what can be done to stop naked short selling? And I will tell you, there is a movement today. We're in a season of change on this topic after 20 years in the ditch. Okay. The season of change is happening because there are really a large group of people, Jason referred to them before, Reddit, Wall Street Bets, et cetera, community. I'm told there's 10 million of those people worldwide. Those are the people that squeezed GameStop, and somehow Stevie Cohen and SAC Capital and Robinhood got out of the trap. I haven't figured it out yet. Don't have time. I'm not involved in that case. Okay, all I know is there were billions of dollars that they had to come up with, and I don't think anybody ever wrote the check that I saw, but who knows? I'm not aware of the facts. But basically, that group combined with a movement amongst CEOs, there's now organized CEOs and many of our clients that have, go to the internet and look it up, CEOs against naked short selling. You're going to see they're grouping together. There's companies in England, there's companies here that are now gathering together to fight this. Because at the end of the day, ladies and gentlemen, this not only robs us of our retirement, some of our retirement, it destroys capital markets, it destroys jobs, it destroys technology. Most jobs in this country, according to Dr. Rob Shapiro, come from small cap companies. Well, if Wall Street makes more money off of killing small cap companies than they do building them up, who in the heck is going to want to start a small cap IPO? Not very many people. So that's why you're seeing more people go to private equity. This is also depriving us of incredible technology. Don't forget, we're the United States of America. We're supposed to have all this technology. Well, that's being, impaired by virtue of this illegal practice because they can rig the market easier than they can take the risk go up. In fact, I submit from where I sit, it's riskless. It's riskless because if I could print as many shares as I want to sell, when supply exceeds demand, the price is going down almost every time, and you got a lock on a short position. What do we need to do? I'm going to read these real quickly, and then we'll turn it over for questions. I got 1 minute. We're going to eliminate exceptions for delivery of shares such that every share sold must be delivered. For God's sakes, do you know anything else in America you can sell and not deliver and get the money? It doesn't exist that I know of. Who is allowing this? Wall Street, Congress, that's who's allowing it, although I'm told this session of Congress, not going to get into all who I've talked to in Congress. Many are going to try to do something about this finally. Deter illegal conduct of brokers by large fines and prohibit trading the company stock when they fail to deliver. If you fail to deliver time after time and you don't reverse that transaction and return the cash, it needs to become a crime. It is a crime. It's stealing. It's real simple. Deter illegal conduct of market makers by implementing a system that could result in revoking their license. If you're doing this spoofing, which is systemic also, if you're doing that spoofing and you do it continuously, you need to go to jail. It's real simple. Require transparency by requiring brokers to report how many fails to deliver they have on a daily basis. Don't report the company. Reg Show reports the company that got raped. It doesn't report the company that raped them. What kind of logic is that, for God's sake? Okay, be transparent. If you're cheating the system, post what you cheated. Okay, then you're probably going to eliminate most of the cheating. Doesn't take much common sense to figure that out. Require transparency by requiring disclosure of any ex-clearing. That's something else I didn't even cover. Not only do you transact through the Depository Trust Corporation, you can ex-clear. Prohibit brokers from lending shares more than once. You cannot rehypothecate the same share. Every time you rehypothecate, you create a counterfeit share and you exacerbate this problem. Create an outside third-party agency. There's an idea where brokers have no influence that can oversee this, kind of like the Bar Association. Put some common people on there that are smart business people. So at the end of the day, this is a big problem. I encourage all you as lawyers to stand up and help fight this. If you have clients there, do something about it because we have to solve this problem. Let's don't forget, we as lawyers have to make a difference in people's lives, not just a living. That was one of my mantras, is to be blessed to be the chair of the litigation section of the State Bar of Texas. We are the gatekeepers of justice in this country. And with that, I'll yield back to Jason or yield back to Domenica for questions.
Yeah, we have about 10 minutes or 8 minutes left. So thank you, Wes. Great job. If anybody has any questions for myself or Wes, please feel free to use the chat, the Q&A. We have them both available so we can help.
I don't have that on my screen, unfortunately. I don't see any questions.
I got you. If they come in, I'll read them out to you.
Thank you. I'm a dinosaur in this area, so I'm older than you, Jason.
That's okay.
But rode hard and put up wet, as we say in Texas. So
we've done a lot of these, so I'm getting used to it.
Well, thank you both so much for giving our audience a lot to chew on, for sure. It doesn't look like any questions have come in yet. Are there any final thoughts between the two of you that you would like to leave the audience with, or?
Well, I'd make a couple final thoughts. If you're interested in this, go to a website. We created a nonprofit called nakedtruth.info. It's Naked Truth Inc. The people that work there for free. It's a nonprofit. It runs lean and mean. It has not all, but most of the information I've talked about with a lot more detail on it. So it's a repository of information for anybody that wants to look at it. Nakedtruth.info. Also, just put on YouTube was an older documentary on top of Gaming Wall Street, which I guess brought me here, is The Wall Street Conspiracy is now on YouTube. It's free. I would watch that because that too is going to give you some insight into this. Yeah,
I agree. I've watched the HBO Max, the documentary Gaming Wall Street, a couple times. It's 2 episodes. I encourage people to check it out. If you enjoyed what you heard today, it's going to be a little more in depth to what we talked about. You're going to hear from a couple different people. They're going to talk about a couple different things with some actual detail examples. Wes is part of that. And it's the more people can know about this and understand it, the more it will help create some more fight like what Wes is trying to accomplish. So I admire what they're doing.
Yeah, integrity in our marketplace, for God's sake.
Absolutely.
We have to know it's a fair system for everybody, not just for the rich fat cats. Okay. I mean, that's
Well, thank you both so much. Doesn't look like any questions came in, but I can share your contact information if that's okay with both of you, if maybe some follow-up
Yeah,
questions.
sure, that's fine.
Sure.
And can you
Awesome.
also send us the recording itself?
Absolutely, absolutely. The
Like
recording
just
will be
have
made
it put on our
available.
website and, the normal
Yeah,
stuff. Okay?
absolutely happy to
Domenica,
share that.
thank
Well, thank you
you.
both.
Yeah, thank you, and thank Carrie for us, and Jason, great to be with you, and honored to be here with the fellow lawyers that had listened in.
Awesome. Well, everyone, I'll get the CLE survey out to you shortly. Thank you for tuning in, and we'll see you next time. Have a great afternoon.